points. Return on capital employed and potentially EVA, economic value added related to that, are really important. I personally find them a little bit underused because they take a little bit more effort into calculating than some of the basic numbers. But I think overall, revenue growth is of course really important to understand, both historically what it has been and of course what the future potential is for that. And then the profitability either through EBITDA or EBIT margins, although my personal favorite actually the one in between those, i.e. EBITA, because D or depreciation is a real business expense. You can't swipe that under the floor, whereas amortization, the A, is it's more of a accounting mechanism that isn't cash based or may not be real. So I think EBITA would be the key one to look at. However, you can't always find it, and it's a little bit tricky, and it's not comparable to other companies. So that is what makes it a little bit more difficult to use. But if it was available, that would be my favorite one. But that's on the profitability ratios. But then to really understand the value creation of the company, you have to take the capital employed into account, and then you look at either ROCE or EVA, like I mentioned. Essentially, one fairly good tool is a ROCE tree, as we call it. So you have ROCE here, and then that is a function of EBITA divided by capital employed, and then the EBITA is a result of revenues minus cost item A, B, C, D, and then the capital employed is fixed assets and net working capital, which is then and net working capital is based on accounts receivable, inventories, and payables, and so forth. So you can disaggregate all these factors, and then you can also make trend analysis as to how have the gross margins developed over time, and how has the net working capital on this side developed over time, and how has the tax rate developed over time, and then you can also make comparisons to peers to understand where they are under and overperforming. So that is, I think the ROCE tree is a fairly good mechanism for that.
And then it could be, for example, I'm covering technology stocks. Many of the companies that I analyze are like really high growth, investing in growth, not profitable. You're basically, as an analyst, I'm left with enterprise value to sales multiple. Yeah. And I don't have support from many other models, but they can be really, really attractive investment cases, even though you don't have anything else but the enterprise value to sales multiple.
Most likely the one that would be used mostly. It's important that the entrepreneurs understand what is enterprise value. That they sometimes they don't understand the depth is not very instrumental in most of the growth cases. You don't get a lot of depth usually, so they don't kind of understand what's the concept. But that's of course an important part. But on the SaaS metrics, you are now getting a lot of different SaaS metrics. So for the software as a service companies, that they can be in very many different kind of categories. They can be games, or they can be B2B software. But all of them, the basic most important metric is really how much does it cost for you to get one customer, new buyer, and what's the lifetime value of that buyer. So that ratio should be that the lifetime value should be at least 3 times the customer acquisition cost, and you should be able to grow the business on a month-on-month basis on 10% or more.
EV, enterprise value to sales, enterprise value to EBITDA, are interesting and relevant in the sense that those are quite often the multiples that, for example, the sellers of the business tend to communicate. What I try to always look at very carefully is cash flows compared to the enterprise value.
I usually look at return on equity and return on capital employed, which is a little bit better as it kind of takes the whole capital structure into the play. So not only equity but debt as well. So yeah. So you can boost your return on equity by adding leverage. So that's in return on capital employed is in that sense. I tend to favor that one. So. Yeah. And then again, if you're looking for kind of multiple based, then it's my favorites are enterprise value to EBIT, and if it's a kind of a capital intense company, then you tend to take EV to EBITDA. So even though we have a restricted amount of companies to cover, then just kind of doing the maintenance work and updating the models constantly, because basically you would have to do it all the time when you have new information about the company or something changes. So it's easier to track on the multiple side. You could also play a valuation on a kind of what would on a steady state over the cycle kind of multiple and figuring that out, and what would be the over the cycle valuation of a company that I would be willing to pay.
I normally look normal profitability ratios. What is EBIT percentage? What is EBITDA percentage? What is return on equity? What is return on invested capital? Gearing ratios.
Quite often we talk about, for example, EV/EBITDA is kind of closely followed multiple. Of course, in many industries, it's probably not the most relevant one, but it's a good proxy of cash flow. Which, personally, I mean, given the latest changes in the accounting standards, I typically at least want to check how the EBIT links to the equation because of very different accounting standards, for example, between countries and so on. But I mean, typically we look at many multiples, and we need to understand that if someone differs seriously from the others, then why that happens. And there are normally reasons, and of course if there are not, then you need to understand why the situation is so.